Welcome to the Old Fashioned Real Estate Show, Brian. My name is Jeff Holst.
Brian Leverage.
Exactly. And I'm super excited about our guest today because our guest today is an amazing person. Did you know that?
From what I've heard and seen.
Yeah, no. So listen, our guest today made his first ever investment in 2002 and was able to quit his full-time six-figure corporate job by 2005. He did that through investing in multifamily real estate. He's often referred to as the apartment king, and we're going to have him right after the break.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst for our old fashioned real estate advice.
Hey, Brad, welcome to the show.
Hey, I'm happy to be here, and man, after watching that Old Fashioned, I'm thirsty right now.
I know, but we didn't even make you bring an old fashioned today because I heard you were doing 75 hard and I didn't want to tempt you.
I just finished. I finished on the 19th of March, so
yeah.
I am done for now.
Oh, if I had known that, I would have definitely sent you a bottle of bourbon or something. So we actually do normally drink on the show, but we thought we don't want to create any issues for the apartment king. So hey, thanks so much for being here today. I was talking with Brian just a little bit before you showed up on camera here, and I was telling him about how great your content is because I've been to AIM NatCon twice now. I love it. It's great stuff. And, I have several friends that are near mentorship programs, and they seem to be just killing it. So I'm really excited to have you here, and I really just wanted to talk to you a little bit about apartment investing, which is something Brian and I do a little of as well. So you started investing back in 2002, right?
Yeah, I can't believe it's been 20 years as of like this month, actually, was 20 years ago.
Yeah, that's crazy. What was what was the motivation to get started in apartments?
Oh my God. Well, I was one of those struggling corporate America guys. Neither of my parents finished college. And so it was impressed upon me that, I need to study hard and get good grades and go to college and get a job. And I did all that. And then I had a job and I wanted a different type of job that paid more money. And then I was fired and laid off. And I really spent 14 years just kind of trying to find my groove and never really found my groove. So I was actually, you may have heard the story, Jeff, when I tell it at my conferences, but I actually started studying for my third degree after getting an engineering degree and an MBA. I was preparing for the LSAT in the year 2000.
That hurts me as a recovering lawyer. That really hurts me. You're lucky you didn't go down that route.
Well, you're not the first recovering lawyer that said that. So I have another data point that tells me I made the right decision. But a book came out that year that changed my life and probably yours and many other people. That book was called Rich Dad, Poor Dad. And so I read that book and it was like, formal education will make you a living and get you a job, and specialized education can make you a fortune. And I took the LSAT preparatory material and I cleaned it off my desk and I started researching real estate investing seminars. And that's how I got started 20 years ago. I went to a seminar and I learned from Kiyosaki that I was in the rat race. I never would have called it that back then, but that's what it sure felt like. And, especially after being told I wasn't smart enough and didn't come in early enough and didn't stay late enough and didn't have what it took. And so I went out and sought specialized education, and that's what got me into real estate. And within 3 years, I was able to get out of that rat trap. And to me, that was all about replacing my earned income, my W-2 income, with the cash flow from my apartment deals.
Yeah, that's so great. Speaking of Kiyosaki, by the way, I have to thank you for this. At AIM NatCon, I think 2019, I actually had an opportunity to meet Robert Kiyosaki. You actually had him at your event, and I was able to get my picture taken with him, and it was just amazing. So thanks for that. That was like because that book changed my life, I was willing to pay almost any amount to do that. So, and it was super reasonable on top of that.
So are you saying I should have charged more money for that ticket that you paid?
You definitely should have charged more. Yes. I would have happily paid it too, actually. So, in fact, I think that like it's it's one of those things. It's not every day that you get a chance to like shake a hand and thank someone that really had that kind of impact on your life. So thanks for giving us that opportunity.
And was he friendly to you, or did he bite your head off?
Yeah, so he was actually fairly friendly to me because our mutual friend Robert Helms from the Real Estate Guys actually walked him over to me and was like, hey, this is my friend Jeff. He's going to climb Kilimanjaro. And Robert had just done Kilimanjaro. So we had a nice chat about Kilimanjaro. So,
nice.
but a lot of people, he was snapping at him for sure.
Yeah, well, he's a good man. He became a friend. He's been at my conference more than once. But yeah, like I said, you don't want to approach him at the wrong time for that selfie photo.
No doubt. Well, Brian, do you have any questions for Brian? I hate to monopolize the conversation.
No. So, you made that transition, but why don't you talk about the transition going from your first apartment deal to, I know you started with a couple, say, smaller ones, right? 20, 40 unit type properties. And then you made the jump to the larger, 100 unit type stuff, and why you did that.
Yeah. And see, if I had known then what I know now, I would have skipped my first two properties. So I'll tell you about that. So my first two deals were my first one was 32 doors and my second one was 30. And when I started, I had a mentor. I went to a seminar and I bought their mentorship program. And at the time, they weren't really teaching syndication because that's not what the mentor was doing. And so he told me, he said, hey, buy as many doors as you can under one roof, with as much liquidity as you're willing to put down as a down payment. So my first deal, I put 200 down, I got an $800,000 loan and bought a $1 million property, and I got 32 doors. And then my second deal, I bought another 30 doors, very close to the first one. And by the way, that's when I learned about economies of scale, because managing 62 units that were pretty much right around the block from each other was so much easier than managing 32. So with 62, I was able to afford a full-time manager, a full-time maintenance person. With 32, I was sort of mom and popping it and doing a lot of stuff myself. So I basically bought myself a job buying that 32 unit building. And so the thing is, now I have 62 units, but I used all my money. I don't have any more money. And a 250 unit deal comes my way. And I really wanted to buy it, but I didn't have the money to buy it. But this is when I was already networking, and I was going to other real estate networking events, and I was building up an investor database, because I knew at some point that a deal would come to me and I wouldn't have the money to buy it. And so what a lot of people would do is they'd just say, hey, I'm not going to do that deal. I'm going to stay small. Like, I'm in my comfort zone. Like, I don't need to go big. I'm happy doing this. I don't need more money. I don't need more stress. I don't need investors. I don't need to deal with the SEC. But here's the deal. Playing small doesn't serve anybody. And so I went ahead and said yes to that 250 unit deal. I raised $1.9 million, and that was my third deal. So that was the jump from buying my own deals with my own money to syndicating deals. And now, as you know, I'm a big syndicator, and my students are syndicators. And so, what I teach my students now is you can skip the 30 unit deal and just go right into your first syndication out of the gate. And that's what hundreds and hundreds of them have been able to do.
Yeah, it's amazing. It kind of makes me feel like I'm going the slow route sometimes then, because Brian and I, we're still buying a lot of 20, 30 unit deals. No, in fairness, we buy them all in the same area, so we do get some economies of scale.
Yeah.
But yeah, I think there's real wisdom to jumping ahead to the bigger deals, because there's a lot more flexibility and there's a lot of advantages to them.
So do you have to make different broker relationships, for the larger stuff than typically with your C class, 40 unit type property?
You do, but I just wanted to say, back to Jeff. I mean, look, to me, the riches are made in the niches. So you guys have a niche, and I have a niche, and so it's not good or bad, right or wrong or whatever. And but like my niche is syndicating 60 units and up, and I'm able to transfer that step by step to newbies and help them do it. But so Brian, yeah, it's like, just like in your business, I'm sure there are brokers that specialize in, like if I ask you, well, how do you find these 20 to 40 unit deals? You have, there's a way you're finding them.
Right.
And so how do we find these 60 unit and up deals? And there are brokers that specialize in C class. Like there are some brokers that specialize between 10 to 25 million. And there's other brokers that specialize in A class over 50 million. And so it's really just about learning from other people that are already doing it. Like when I wanted to buy A class deals, I didn't know those brokers. And so one of my informal mentors, meaning I don't pay him, but he kind of takes me under his wing, and now we're buddies, and he speaks at my events. And I bought one of his deals, and so we have this, relationship. But he introduced me to like his top 3 brokers that he buys A-class properties from, and so he was able to get us in the door when I wanted to buy an A-class property. So probably not too different in your business, but it's about building the right relationships. And and when you buy larger deals, it's really about like who you know. And so when you're new, you have to leverage somebody else that knows somebody. And so like, because if you're on the outside looking in, you'll say, hey, there's no good deals.
That's great advice.
There's tons of deals. Yeah. You just got to be on the inside.
Yeah, that's been our experience with the deals that we do too. There's a lot of people saying, "Oh, I don't know how you find these deals," and it's like, well, you just gotta, you don't know until you start talking to people and see what's
because if they're out looking on LoopNet and stuff, or they're like, "Oh, there's no good deals," they're like, and then they get all excited when a broker brings them an off-market deal, but you've probably already seen that off-market deal and passed on it.
Yeah, no. Usually we see it like 2 or 3 times before someone else sees it. It seems like. So do you think it's harder now than it was when you started in 2002, or even when Brian and I started, 2010 or so?
Well, harder is relative. Let me just say there's pros and cons. So there's a lot more awareness about multifamily now. So when I started in 2002, it's like there just wasn't as much demand for people to buy apartments. Now, maybe there was, but in my perception, maybe there wasn't as much demand. And then you didn't have the, like I consider myself a market disruptor on the buyer side. Like there's my organization, which is arguably the number one, apartment education and investing platform that helps buyers syndicate deals, but there are others out there as well. And so there weren't that many groups around at that time. So, like who was buying a $10 million deal 20 years ago were basically, a handful of people or larger companies or REITs and stuff like that. And now people buying 10, 20, $30 million deals are it's well within reach of a new syndicator. And so, there's a lot of, like my group and some other groups that have created these buyer organizations, and there's a lot more awareness and demand in general for multifamily properties. It's one of in the last 5 to 10 years, it's been one of the darling asset classes of real estate. So from that perspective, like the lenders, it's easier to get lending on multifamily now than when I started. It's easier to raise capital now than when I started because there's more demand and more awareness. Now the challenge is like finding great deals. And it's always been challenging, but it's still challenging. But again, you got to be on the inside. I mean, we get deals brought to us all the time.
Yeah, that's so I guess I wonder, are you worried then about like just the prices have gone up dramatically, interest rates are starting to trend up, so you're not super afraid of those things right now?
Well, I got to level with you guys. I'm always worried. I mean, I am. When I bought my first deal in 2002, I felt like I was overpaying for it. It was 30,000 a door. The interest rate was 6.3%, and the rents for $400 a month. Now I'm buying deals at 180,000 a door. The rents are $1,600 a month, and the interest rate's 3.5%. The numbers still work out, but I'm always look. I just came back from a seminar. Me and my wife like to go to a lot of masterminds where we surround ourselves with people 1 or 2 or 3 levels above us. So we just came back from a mastermind with Tony Robbins, and he brought in 6 billionaires: Ray Dalio, Howard Marks, Paul Tudor Jones, and then he had Larry Summers, who was the former Treasury Secretary under the Clinton administration. And it's like one of them said, I can't remember which one, but by the way, all of them said right now, inflation is the problem and we need to be in assets that are going up faster than the currency is going down. And that's real estate, right? And we need to be in real estate where you could adjust the price people pay, i.e. we need to be in real estate that doesn't have these long-term leases like with apartments, every 6 to 12 months, the leases are up. And so you could raise the rents. Okay. So that was one of the things that all the billionaires said, but there was one thing that, getting back to, am I afraid? He said, if you're worried right now, you might have less to worry about, because when you're worried, you double check and triple check everything. You triple check your assumptions, your underwriting, your checklist. When you're not worried, you're overconfident. And let me just say this, I've always been not on the extreme case, but I'm always a little worried. I'm always a little concerned. I'm always afraid that like something's going to crash and burn. Like, Jeff, we go to some of the same events and we listen to some of these speakers that, are always predicting the next crash is going to be bigger and worse than the last one. And it's, all hell's going to go there, So yeah, I'm always a little worried.
Well, listen, I mean, so another person I met at one of your events was Harry Dent, right? So you had Harry at your event.
Oh shit! Well, he's the worst one.
Yeah, and Harry's been predicting every crash forever, right? It's been a crash every day, and I'll tell you, and hopefully Harry doesn't watch our video right now, or he'll know my secret. But when I was talking to him in the hall at your event at AIM.con, I was having this conversation. He goes, "Hey, this is a great conversation, but I'm late for lunch with Kiyosaki because I think you guys had like a speaker's lunch or something." And I was like, "Hey, no problem. We'll just pick this conversation up in Puerto Rico next weekend." And he's like, "Oh, you're going to be in Puerto Rico?" And I was like, "Yeah." And then I bought a plane ticket to Puerto Rico so I could hang out with Harry, because that's, I think, is a secret to life, right? Is when you have an opportunity, you got to seize it. And so I ended up having a couple-hour conversation one-on-one with him where he predicted the demise of the world. This is 2019, hasn't happened yet. But since then, I've become really friendly with him. So, but I'll tell you, he is constantly saying the same stuff. It doesn't matter if he's on camera or not. He says the same thing all the time. The world's going to crash. Everything's going to fall apart. But when he came on our show, on Old Fashioned Real Estate, he said, the world's going to crash. And if I had to invest in something, I'd invest in T-bills. And if I wasn't investing in T-bills, I'd buy cash flowing multifamily real estate.
Yeah, he was just at the Tony Robbins event in Palm Beach 3 weeks ago. And I had the conversation with him. Look, you met him at my event. I'm buddies with him. I hung out with him in the back of the room before he went on stage. And he got up and talked about this global crash that's going to happen in the stock market and in global real estate. And then I pulled him aside after and I said, well, Harry, is residential real estate in Shanghai and Hong Kong or Vancouver different than multi-family real estate in the Sun Belt? And he's like, oh yeah, it's like rental real estate is much more resilient than
That's exactly how he says it.
Markets. And I'm like,
Yeah,
well, why didn't you say that from the stage?
He never does. He always says the doom and gloom stuff from the stage, but then when you have him off the record, it's like, well, yeah, I mean, there's some places that are good. But he actually did say that at AIMNetCon that multifamily was a preferred asset class. I remember
absolutely.
Yeah.
Well, so that leads to an interesting segue, though, is, you mentioned, you're nervous on pretty much every deal, or you're constantly checking, and we're kind of the same. I mean, a small tangent. We bought a building the first day of the COVID shutdown. And I remember going to the closing table and literally going, shit, I don't know. Do I still want this thing? And just sort of that uncertainty. I mean, it was a really good deal. We bought it, but
and since sold it and made a little bit of money on it.
Yeah.
So it could have been
but all that's to say is, with maybe a little bit more of uncertainty we're looking at currently, both politically, economically, et cetera, have you changed your underwriting approach to, buying?
Yeah, absolutely. And let me make sure I get back to that, but I just want to clarify something. I'm not afraid, but I'm cautious. Mm-hmm. Okay. And when I guess when I say I'm worried, I call it a positive worry because it just makes me make sure that I don't miss things on my checklist. Okay. And so what I really want to communicate to people listening out there is don't ever be overconfident. Now let's go back, Brian, to what you said. I also have a high degree of certainty. So how is that I could be worried and concerned and cautious, but also certain? Well, I've been doing this for 20 years. And I listen to a lot of people like Harry Dent and like Paul Tudor Jones and like Ray Dalio and like Tony Robbins and like Grant Cardone and also people that maybe you didn't hear of, like Charlie Young, who owns 25,000 units, and Mike Becker, who has 12,000 units. And I watch what people are doing, and then I become the CEO of my own decision making, and I chart my own course. And so I get a lot of data. And then I look at the 2 of the 4 people that I really feel like I can trust the most, and I kind of watch what they do and I follow in their footsteps. And so when you have to be underwriting deals differently now than even I was 3 months ago, because look, okay, let's just talk about the last 2 years. The pandemic came and there were supposed to be rent strikes and nobody was going to pay the rent. So there was about 3 months of highly uncertain times. March, April, May of 2020 is what I'm talking about. But none of those things happened. People paid the rent. 98% of tenants chose to pay the rent, even though in the moment they didn't have to. They would have had to eventually, or it would be on their permanent record. And so because of that, 98% of the tenants in the markets that I invest in, which are landlord and business-friendly environments, chose to pay the rent. Most of the people that lost their jobs are back to work, maybe in a different capacity, maybe in a different company. Now, a year ago, they were saying it was the best time to hire people because talent was on sale. Now, talent costs 50% more than it did a year ago. And you guys probably know that.
Yeah.
So wages are up, income is up. There's a lot of reasons for inflation, and it's not just because people are printing money, the Fed or the government's printing money, but like everything is more expensive now, and it's even including hiring people. And so, I don't know where I left off with the question, but you have to underwrite. That was your question, I think. So like, I used to underwrite multifamily deals forward-looking 5 years, and I'd use rent growth of 2 or 3%. I'm not using 2 or 3% right now. I'm using higher numbers based on what's happening right now. Now, I might be at 3% in 5 years, but like my year one rent growth right now in Dallas or maybe in Tampa, and you got to know what's going on in the market. You can't underwrite the same in different markets because it's different. So I'll find out what's going on in that market. But I just underwrote a deal in Dallas where I'm using 6% rent growth in year 1, 5 in year 2, 4 in year 3. I'm using 8% vacancy. I used to use 10. I'm using 8% vacancy. I used to use 10% vacancy, but we're at an all-time low in vacancy right now. So if you're not constantly pivoting, and that's one of the things that I do and teach, you have to be a student all the time, and you have to look at the data. And if you try to just put your head in the sand and do it the way you always been doing it, you're not going to be successful.
Yeah, that sounds exactly right. And that's been what our experience has been is like, and this is where I think like being involved in a group like yours is really useful because, and it's one of the reasons I go to conferences, right? It's because I want to be exposed to what other people are doing, what they're thinking. And what you're doing is you're putting all that together in one place, which is, I think, really fantastic. Because Brian and I are sitting here every day after we get done with our regular workday going, okay, what do we do? How do we change this? Like, what's going to happen next? And we have to have these conversations constantly to sort of read the future. And it is a bit of a guessing game, but at the same time, when enough people are looking at it the same way, you can get that level of confidence that you're talking about, which I think is amazing. Well, listen, we're about to wrap up, and I want to talk to you about your upcoming events in case people want to reach out to you. So I know you have an event coming up next month. Or maybe 2 months from now, something like that. Rat Race to Retirement. What can you tell us about that?
Yeah, so I call it Rat Race to Retirement because it's how I went from the corporate rat race to retirement by buying multifamily properties. And so, look, it's a 3-day event. It's May 13th, 14th, and 15th. I used to do 3 of these a year. Right now, I'm only scheduled to do 1 because I'm doing less events. I'm doing, that takes a lot of time. I'm going to a lot of events, but I'm producing less events myself. So this is going to be the biggest and best one ever. And what you will learn at this 3-day event is, well, let me just tell you the outcome. My outcome is that you learn how to go and syndicate a 100-unit building. And so, what I teach in this event are the framework that I do for all of my deals. So I teach like how to find and analyze deals, because that's number one. And you got to be able to understand what a good deal is and what a good deal isn't. So you're going to be able to understand analysis. You're going to be able to find deals. I tell people how I find deals, where I find deals, where I don't find deals, and strategies that work and don't work. And then when you find them, you got to analyze them. And then I teach you how to fund them. And funding consists of equity and debt. And so we talk about raising money, and we talk about compliance, and we talk about debt strategies. And going back to Brian's question, Brian, one of the other pivots that we made is the debt strategies now are different from 12 months ago. And so you got to be pivoting. And so we're going to be talking about what's working right now with finding deals, funding deals, the steps to getting a deal under contract, and the strategies that work to actually get your deals under contract. And it's, if I could say it, this isn't bullshit stuff. This isn't theory like some guy, I see what's going on Facebook and social media, and these guys talking about, oh, I'm going to teach you the secrets to how to get your deal, selected. And I'm thinking, the guy teaching this course, he hasn't bought a deal in 8 years. How can he teach somebody how to buy a deal because he's not buying anything? Like, what the hell?
Yeah, there's a lot of that going on.
I mean, like, oh, I'm going to teach you, what they don't want you to know about making offers. And I'm like, look, how many offers have you made? Like, I'm in like 2 best and finals right now. Personally, I did 2,700 units personally last year. My students did 72 deals last year that I personally mentored, all over the country in 27 different markets. I mean, I know how to get offers accepted. I know how to find deals. I know how to analyze deals. I know the debt strategies. And I also know that what worked last year ain't working now. And you got to pivot.
Yeah, that's great.
And that's what I'm going to teach in 3 days.
Yeah, well, so people can find out more about that, I think, at your website, bradsumrok.com. There's an events tab there. Anything else you want to share with us before we go, Brad?
Well, I mean, I just want to thank you for having me on, and just to say, yes, like the one thing I do want to share is that there's a lot of ways to make money in real estate. And I mentioned niches, riches are in the niches. And for me, it's been buying apartments. And so, for maybe somebody out there, they'll resonate with this show. But I do need people to know that this is something just about anybody could achieve. Okay, you don't need to have experience. You don't need a lot of money. You don't need to be like, an A student. And you just need to want to do it and commit to it. Just like anything else in life, it's just like if you commit to it and you surround yourself with the right players and the right team, like anybody could go out and buy a 100-unit building. And I know that because I've helped hundreds of people do it. So anybody that's listening thinking, hey, hey, maybe I want to do this, but I'm going to start smaller or do something else. Like, I'm not saying that's bad. I'm just saying that you can do this. Anybody can do this. I know that. You guys have seen it. You've come to my events, Jeff, and probably met some of my students. And so that's the message. And the other message is 2022, there's a unique opportunity to do this now. The preferred tax strategies that were passed in, not tax strategies, tax laws that were passed in 2017 for the most appreciation benefits are going to start phasing out at the end of 2022. And eventually the supply will start to meet the demand. But right now there's so much more demand than supply, and the interest rates are starting to eke up. So like there's a window right now for people to still get into apartments and for lack of a better term, to make tons of money.
Yeah, and you are right. Brian and I are both huge fans of bonus depreciation and cost segregation and all that. We've done a couple of shows about those topics because it's unbelievable right now, the opportunity. In fact, I think it was Tom Wheelwright that first got me turned on to that, and I think that may have been at one of your events as well. But once I heard about cost segregation and bonus depreciation, I immediately went to doing it, and I haven't paid federal taxes since 2017 when they changed the law, and it's so amazing. It's actually stupid, right? I mean, it doesn't even make sense. And I'm not going to pay you this year. I can't predict the future. But
yeah. Well, good deal. I'm glad to hear that.
Yeah, no, thanks so much for being here. And everyone who tuned in, if you have any questions for Brad, I'm sure he will be happy to respond if you reach out to him directly on his website. Thanks so much and have a great day.
Thank you.